Good afternoon, everybody, and welcome to our webinar here. We got 120 minutes or 2 hours jam-packed. We got a panel of set of four people. We'll introduce them in a few minutes. But just to kick things off, I'm Rod Schulhauser, Director of Marketing here at SVN Rock Advisors. And just a little bit of housekeeping before I turn things on over to Derek Lobo. First of all, make use of the Q&A, use your Q&A inside the chat box. Our team of panelists will monitor that and we'll integrate the questions into the content, and we'll do our best to handle them all. But that's the best way to do it, and that way we keep everything going. Also, just a few things that are coming up. Of course, we're not only at the beginning of summer here, but you know what? December 3rd may happen sooner than we like. Hate to say that, but the good news is we got a fabulous event happening at the beginning of December, December 3rd, as part of the Toronto Real Estate Forum. And the agenda is set. You can read all about it there on the Toronto Real Estate Forum website. There's a QR code there on screen to take advantage of some pre-event pricing and things like that. Definitely worthwhile. I know we've already got Jennifer Keesmaat confirmed as the co-chair and one of our keynote speakers as well. There'll be a few other surprises that I know you'll be happy with. One of the other things that we've been spending time with, and we're getting a lot of inquiries about, something about the self-funding house, a developer program. And that program is all about affordability solutions for home buyers, builders, and investors. But I want to specifically just touch on the developer program, because many of you here on this webinar are in the apartment development arena, and you have or are partnered with home building divisions and so forth. So I just wanted to share this very, very quickly. One of the reasons that we're seeing this impact and why developers are very excited about this is the impact of affordability. I thought I'd just share this graphic. You know, that household income of 180,000 needed for the average house price of about $750,000 here in Canada. That's the household income needed. We've used that 1/3 towards housing. And that's why the younger generations and why affordability is really a struggle in our country. But the self-funding house is all about adding ADUs, basement apartments, and you take a secondary market like London, Ontario, a $1,500 a month basement apartment rental takes that household income down to 117 when the banks acknowledge the rental income towards mortgage qualification, and that's what this program does as well. Similarly, the savvy business owner, a young couple, young person, can actually choose to live in the basement apartment. And these are not basement hole in the wall apartments. We're talking, 8, 9 foot ceilings. We're talking as good as the upstairs in terms of fits and finishes. So living downstairs, renting out upstairs for almost double the downstairs rent, takes a household income into a dramatic difference. And this is the aha moment that a lot of the younger generations realize, that 180,000 can come down to about $60,000 when you look at your business, or you look at your home as a business. And we're also seeing, because of many investors leaving especially here in the GTA, leaving the condo investment market, they're moving into the single family home as an investment potential. And so in this model, again, with the same things, you can see it's a positive cash flow. Now, I'll just end off with this to let everybody know, because you can reach out to us and we can take your inquiries along with the other developers. We do have prototype success. In fact, we have 4 developers across the country that are currently implementing self-funding houses. These are houses with these basement apartments already part of it. They're geared towards investors, first-time home buyers, and this is already in place. In fact, there's been over 50 sales of these homes in our country in the short period of time that they've been available. And as always, we've got the public-facing books that have been written for the home builders, the homeowners, the investors, supported by an online learning portal. But this is something that we're seeing and is getting a lot of attention. So just wanted to share that with you to let you know you can reach out to us and we can obviously take your questions about that.
Let me just say something on the self-funding house, okay? This is something that we need to do, as a country, to provide more housing. People who aren't housed well aren't good citizens, and they're not happy people. So this is good for all of us. What we've concluded in the work, it's been a good 18 months since Rod and I have been going hard on this concept. The idea of building a basement apartment is not new, it's old technology and so on. What we have to create, and Michel, this will involve you, Darryl, we talk about this all the time, is a financing product. Fair enough? And a sales and a marketing product to educate young people that you can be in the housing market, okay? It hasn't gone beyond you, but you can't get to traditional house that your parents had. Fair enough? this self-funding house will allow you to get into the market. But for any of you that are on, that are mortgage brokers, financiers, on any side of this thing, we need to be talking to you, because you can be making great loans to young people who have strong incomes, but not enough to qualify, but that additional rent will, okay? So we're working on that. If any of you have any thoughts or ideas, we'd love to talk to you about it. Rod, our infomercial is done. We're now getting on with the show.
Well, you know what? We're going to keep on that theme, Derek, because I'm going to turn things over to you and get this show rolling.
So first question you asked is that why are we doing this seminar, on this topic? Well, really, our job at Rock Advisors is to look for gaps in the market. Okay, what are people not talking about that they should be talking about this coming? Okay, and so last February we did a seminar on this topic, about restructuring, new apartment construction. And we're visiting it again now, a year, a couple of months later, and we're going to talk about what we've seen and what's going on. We're also going to talk today a little bit about overall apartment trends, what's happening in the industry. Apartments have weathered any storm that we've been through, whether it be the COVID storm or the interest rate storm, really, really well. But there are storm clouds on the horizons, mainly driven by interest rates right now. And so, we want to talk about how you counsel developers, and where there's a need, how you restructure the capital stack. And we'll go through that with you, okay? So we see this as something that's coming, something on the horizon, but it's been with us for a while, so we talk about what happened in the last year and so on. Okay, Rod, next slide. Okay. We spent a lot of time in the session we ran last February. We took all our content and we put it into what was a pretty good white paper here, okay? So the four of us wrote it together, okay? And if any of you want it, it's available on our webpage, or maybe I think it's already been sent to you in advance. But some of the things that we talked about are in here. It's a good paper on a topic that there's not a lot written on. Okay, next slide. So I want to introduce our panel today. And these are people that we deal with, on a regular basis. Rod, I was just thinking, we are going to get a very low diversity and inclusion score for this seminar. Okay, basically, we got three old white guys on here, right? Low score. Next time we'll have to, we know better. Okay, all right. So today, look, we're SVN Rock Advisors. If you know us, we're apartment people. There's going to be stress in lots of places, in real estate, certainly in office and so on. That's not what we do. We're the one-trick pony of new apartment construction here. So all our comments are going to be based on that. Okay, we're not talking about old apartments that have been here since the 50s, 60s, 70s, 80s. We're not talking about apartment buildings to be built, okay, in the future. That's a separate topic. We talk on that a lot. Today, we're talking about projects that have started, fair enough, or that can't be stopped, because a lot of apartments paused when interest rates went up, right? And opportunities, are presenting themselves, okay? So next slide. So since last year, we've been able to complete 4 buildings that have been newly constructed or were under construction, right? So the apartment communities were 90% complete. Leasing has started, but the financial partner, okay, triggered a sale due to outside pressures. So they called us and said, we're selling, right? So we said, all right, we took it out to the marketplace. We couldn't sell it. It was a 250 unit, community, the 4 buildings together. They were separately pinned, but they were essentially one community. And all the big players had put down their pens. Okay. And quite frankly, the big players haven't picked up their pens yet. Okay. And so we received a few offers, but they were far off the developers' expectations. And so we said, no transactions. We went back, Darryl and I discussed this, and we said, well, really, why is the client selling? The builder's happy to hold on. It's his financial partner that wanted to exit. So we went out, we found a private equity family that we had sold their portfolio for. They came in and took out the equity partner. So the equity partner got out, he got a little bit of money for his troubles, and we recapitalized the deal. So we raised equity from a private family to recapitalize a new apartment construction deal that, well, could have been in trouble. Okay, right? Flip over. So this is the actual deal. Slide. This is the actual deal. Maybe. And maybe there's a delay in the slide here. No, there we go. Okay. So you can see that there's one building in the background in the construction, and then the two smaller ones. You can see one left. There were 4 buildings in total, 3 small and 1 large. And at this stage, we brought in our client to start taking down the buildings. Fair enough. And we had pretty good proof of concept. So the first 3 buildings went down in the first deal, and then the high rise went down the second deal. This deal, to a large extent, was de-risked because most of the construction was complete. The majority of the construction contracts were let. So we were able to go and I think do a good deal to let the equity partner out, bring our client in who was in for the long term. All I'm saying is that we took an opportunity that had failed as brokerage because we took it out to the marketplace to try and do a forward sale on it. That didn't work, but we were able to make it work, and we got a pretty good partnership between the private equity person and the developer. Okay, let's continue on. So we started looking at who is, and this is where I think the slide, the opportunity is going to be when brokerage is not there. Start looking at private money, which is sitting on the sidelines. And there is a lot of money sitting on the sidelines, right? Nobody wants to catch a falling knife. Everyone's waiting for the bottom of the market. So what we've recognized is that there is a Canadian apartment owner that's either in the apartment business or exited that understands the business, and they want to place money, but they don't want to have a hammer or a plunger in their hand. Fair enough? And we're talking here about typically $5 million investments, typically low leverage. And most of the investors we're talking about are over 50 years old and they're Gen 2. So dad started a business, they sold out, they've got a chunk of money, they don't want to be operating apartments anymore, but they wouldn't mind owning some brand new buildings and getting active returns and being passive. Fair enough? So we think that that's an opportunity and generally low leverage. I can tell you one thing, that Gen 2 has a number of worries. It's cash flow, it's maintaining their equity, it's their children, and it's their taxes. Fair enough? And what we notice about Gen 3, and you can't say it's always true, but typically true, Gen 3 are typically not real estate operators. Okay? And so, but Gen 3 are educated and Gen 3 are bankers, and they could make great investments for you and stay in the family business, but not in that property manager, I got a plunger in my hand kind of way. And so we see this as it's got to be a good investment. Gen 2 are smart operators, but they like the idea of getting Gen 3 involved. Okay, so next slide. So when we talked in 2023, about a year ago, this is what we said. Okay, so my question to all of you is, we said expect less patience from lenders, less extend and pretend because it already started, and we said more widespread insolvency. Michel, tell us what you've seen in the last year that's passed.
So from the lending community, we haven't seen a lot of what we expected to see with respect to product being brought to the market and getting liquidated and having opportunities for investors to pick up, good properties at really good rates. It's not that the lenders are not dealing with that. When we talk to the lenders special loans unit is busier than it's ever been. And some lenders actually really didn't have much of a special loans unit, and now it's overwhelmed. But we haven't seen the product actually go to market. The lenders seem to be trying to work it out. And I would imagine that guys like David are starting to feel that. The lenders are looking to work it out, getting lawyers involved, and hoping to avoid bringing it to market.
Yep. David, what are you seeing?
We haven't.
Sorry. Okay. Go ahead. Go ahead, David. Sorry.
We haven't seen a flood of commercial real estate in the pouring out on the liquidation side. We hear that internally at the institutions that the watch lists on the commercial real estate side including residential, are increasing, but the watch lists are growing faster on the commercial, not apartment and residential. I genuinely believe that the housing shortage is giving people a sense that this is as much of a punt as they can possibly do, because they see these values coming back at a later date. And so it's not like there's a 3 or 5 year residential apartment development recession coming. It's more like the ones that aren't going to survive will probably transact something privately to get themselves out of the problem, rather than have it go through the courts or go through the intestines of a major financial institution. It's different for commercial real estate. Commercial real estate has an endemic occupancy problem. If you saw a recent article about downtown Toronto's major towers and the vacancy rates in them, you'd really understand the AAA spaces are all showing significant vacancy rates, and that's putting pressure on that market. So I think people are trying, the patience is coming from people believing that this thing does actually pull out in the next 12 months, as the need for the political pressure for residential development starts to increase, which is where are the opportunities going to be? There are some people that just don't have the liquidity to survive, right? And having a broken hole in the ground that they're incomplete on with some kind of a construction financing on it. If it's major bank financing, and their costs are going up and they haven't got the right budgeting, they are going to be in trouble. But I suspect that they're still going to be able to do some kind of quiet, off the books type of restructuring with a third party investor, rather than seeing it go into the public market quite so efficiently.
Okay. So what you're saying is, behind the curtain, there is activity going on in restructuring.
Yes.
Okay.
Look,
Darryl,
I know one residential. I'll give you an example. This is in the U.S., not Canada. I know one residential owner with over 2,500 units in the southern U.S. is looking to sell that entire portfolio. They're not happy with the performance. That market does not have the same occupancy pressure that Canada does, and so they're going to market with those assets within the next 60 days.
Right. And I think it's fair to say that we didn't talk about this last time, but there are a number of fairly large apartment portfolios coming to the market, okay, in the next month, right? And as brokers, I can tell you that if you said, is this the ideal time to sell a large apartment portfolio? My answer is no, right? So then you just ask the question, why is that apartment owner selling a large portfolio of apartments? Well, there's got to be pressure somewhere in the system to make them want to do that. Okay, all good answers. Darryl, you've been around this business for a long time. What are your thoughts about what's gone on in the last year?
Well, I agree with what's been said so far, that we haven't seen what we expected a year ago, but we believe it's coming. I believe there's going to be more visibility to these challenges in 2025. This lend and pretend that Michel talked about is still going on in some aspects of it. Where I live is in that secondary mezz world and joint venture world, where we're seeing more and more challenges that are coming, and it goes right back to what David was talking about: liquidity. The search for liquidity in a deal, and how we operate is search for that liquidity and then be creative in building a relationship to see where we can add value to their situation. So it's that constant looking for that liquidity, building a relationship, see where we can add value to that individual. And it's a different world than what we lived in 3 years ago. And
Yes.
And we are now addressing it. We are living it, and our job in the mezz world and joint venture world is to first of all find out the truth about where the situation is. That means doing extra legwork, meeting people eyeball to eyeball, not over Zoom and everything else, so. And
Yeah,
we
yeah,
do,
yeah.
and we work on solutions. We're working on,
Right,
we're
right.
solution based.
Yeah, you know, what's the first casualty of war? It's the truth, right? What's the
Yeah.
first casualty of a mortgage problem? It's the truth. Getting to where you really are often takes multiple discussions. Okay, so let's run next slide. So remember, we're talking about apartments here, right? So what's good about the apartment business? Well, you already know this, and that's why you don't see a ton of apartment transactions of conventional apartments having really any problem, okay? If a conventional apartment goes up for sale, it's because the developer had a problem somewhere else, right? The conventional apartments, you know, even with some refinancing, as long as you have your, you know, your buildings laddered, right? Nobody's getting in big trouble all at one time. So apartment transactions stable, but typically low leverage, so apartments aren't in trouble. Transactions for sure are lower, and I can tell you significantly lower. Okay, and I think we might show a chart on this. No, yeah, they're significantly lower, but the prices have not changed to reflect the interest rate increase. Fair enough. And so interest rates have gone up 400 points from their lowest, right? If interest rates and cap rates are tied together, they are a little bit, you would have seen a massive increase in cap rates. That hasn't happened. Maybe cap rates have gone up 50, 100 points. But what's happened is the number of transactions has gone down because nobody has to sell. So at some point, there may be a reckoning where people go, okay, this is the new price. Fair enough if I want to transact, but nobody's had to transact and you haven't seen a lot of sacrifice sales. So apartments are
Derek,
good. Okay.
Derek, if I can make a comment there, everything is good until it's not good. People's liquidity lasts, and my experience with businesses that get into financial trouble is that they don't actually go for help often until the very last second when their liquidity is in a dire straits scenario. So things tend to, you know, particularly with smaller developers that don't have access to capital, they'll run the string right out to the very end. Their lender will be watching, and then the ball will drop, and the process will be very quick. You want to participate in that market, you've got to track the small developer, you've got to track the length of time in the marketplace, and then you have to know when it happens and get in front of it right away. It's not going to be a long process when that happens. Those assets will come to market, they'll come to market fast, and they'll be through the markets and tested in under 90 days.
That is extraordinary advice, David. And once they get into receivers' hands, it's a long drawn out process, right? So David, you're saying there's this window here of staying in traffic. When you see a deal that makes sense, move quick. Okay, I think that's worth talking. Michel, Darryl, comment on that. Michel first, then Darryl.
I see more and more clients and builder clients who are realizing now that this is going to take a lot longer than what they expected, and their lack of liquidity is definitely causing serious pain. And they're starting to recognize we have to get rid of some non-core assets and sacrifice some of those assets to create the liquidity. We're seeing a lot of that happening right now, where the extend and pretend, even from the promoter and developer side, has, you know, lapsed. There's too much pain, so we're seeing assets being sold, and I don't want to use the word liquidated, but they're being sold at somewhat of a discount just to create liquidity so they can move on with their current projects.
Right. So, okay. So, but the thing is, you've got to be in the market to see those, right?
Yeah, you've got
to put the, yeah, and that's tricky, right? Because nobody wants to talk about these things either, right? When they get in trouble. And so I guess the point, David, the lesson here is, if you are in traffic and you see these deals move fast, you need to move quickly, because the bank could be stepping in any day now.
If the deal's coming out of the developer owner investor, and you get wind that they're looking for either an equity infusion or to divest a particular asset, getting in front of them and staying in front of them as opposed to, you know, that you come in, they have an unrealistic expectation and then you walk away.
Yes.
That's probably
Yes.
a mistake. Don't walk away. Keep the dialogue running, because as the heat turns up on them from the other side, from their financier side, they may very well want to come back to you. So keep the dialogue open. Don't burn a bridge. There is still an opportunity there. I don't want to say that you're a vulture. You're not a vulture. You're a realistic buyer with a yet unrealistic, not fully aware seller of their own situation. And what you have to do is allow that water to boil a little longer, sit with them, and then be their solution. You're still a far better solution for them than turning it into a secured lender, making an enforcement step every day of the week.
Yeah. Okay, no. Really, really good advice. And I can think of many cases right now where the developer came to us. He was in trouble, but he didn't tell us that. He wanted an unrealistic price. We tried to take it out to the marketplace, and all of a sudden the lender was there the next day. Fair enough. So I think that advice, really goes well. Okay, next slide. So there is a tight relationship between, inflation and Canada's prime rate. You can see it here. Everyone says, where do you think interest rates are going to go? I don't know. I don't think anybody knows. Where do you think inflation is going to go? Maybe that's a simpler question. Wherever inflation's going, that's probably where interest rates are going, and that's what history tells us, right? That's what history tells us. Okay, next slide. So where are rents going? Because look, that is the big thing that determines apartment values. Land is what it is. Construction cost is what it is. But generally speaking, now the USA varies, okay? Some places it's booming, some places not. But on average, you're probably seeing US rents come off a little bit because it's the land of free enterprise and people are building like crazy, right? And so when you overbuild, rents will come down, but that's what keeps the marketplace functioning. In Canada, I think it's fair to say that rents everywhere have gone up, and they've gone up a surprising amount. Probably more in secondary and tertiary markets than primary markets on a percentage basis. But we have seen now in Toronto, rents are leveling off, okay? So we did a survey of new construction in 2023. We probably saw rents go up 12% in this particular neighborhood where we had to concentrate. When we went and re-looked at that neighborhood again this year, we only saw in the next 12 months, we only saw rents go up about 3%. Fair enough. And these are new buildings with no rent controls or anything like that. Part of it is, I think there are a lot of condo buildings coming to the market. Investors bought them 5 years ago, right? They're now getting them. Interest rates are much higher, right? Demand is a little bit lower. So that's where there could be some challenges also with private people owning these. And remember, if we do have a recession, and it hasn't happened yet, but recession impacts both rent increases and vacancies, and we haven't seen that. Okay, all right.
Another small point, Derek.
Yeah, dude.
You don't have to have a recession to have consumer spending depressed, right? It does. You can still have, money in the market. People are still earning, the jobless rate still healthy in the country. You've got all of those criteria are being met, but people are putting just too large a percentage of their budget into interest rates and apartment rental costs or housing rental costs, which is interest rates, indirectly. And as a consequence, that will have an impact. It doesn't have to be a recession to change the spending pattern, right? The spending patterns of the consumer are changing. Where they're putting their dollars right now are changing. And I don't have an answer on that one, on where that actually leads. It may not lead to a recession. What we really have to be more concerned about is the fact that the US is not in a recession. Canada and that the US economy is booming. Interest rates in the US, if the interest rates in the US go down, Canada will have there's going to be an exchange rate issue between Canada and the US that's developing now that could get worse. Productivity in this country is down. Our biggest threat to our economy right now is the US dollar to Canadian dollar. That's a differential in productivity and the higher health of the US economy versus Canada. And so the cost of goods for purchases out of the US, which is a major supplier to the Canadian market, are just going to go up and up and up. And that's going to put a squeeze on our consumers. That's going to hold our inflation rate higher and hold our interest rates higher longer than we expect. The health of the US economy is going to hold our interest rates high.
Yep. You know, we are in a time that we've never had before. Okay. So it almost feels like, I like this term, we're in a melt up. Instead of melt down, we're melting up. Fair enough? Okay. So the world doesn't look that great to a lot of people if you look into it, but the stock market's going through the roof. Because when you print money and borrow money and put it in the marketplace somewhere. So that's creating part of the problem that we have. Okay, next slide. So interest rates and cap rates are tied together. You want to guess at interest rates, I'll give yeah, next slide. So this is the slide of interest rate and cap rates. I'm going to take 30 seconds and walk through it. It says US data. We just don't have this data in Canada, but it's the trend I want you to look at. The yellow line is the buyer IRR targets, right? And so you see that there start about 11%, want about 6%. The green line is US cap rates. And you'll see that the cap rate and the buyer IRR targets are the same, different sides of the same coin. Fair enough. They track each other 1-to-1. Now here's where it gets interesting. Track the green line and the blue line, because a lot of people think cap rates and interest rates are tied together. And that's where the real surprise comes in, where we've seen cap rates go up 400 points, but interest rates go up 400 points and cap rates only going up 100 points, right? So it sort of proves it. But look at the green line and now look at the blue line. So the blue line is interest rates represented by the US Treasury. And you will see that there's not a strong correlation between between the blue line and the green line. You can see that that spread is very low at a couple of points there. You can see in 7, right? We expect that interest rates go back down again. That's the projection. Interest rates are going to go down in 24 and 25. I think everybody was cocksure of it last year that we'd have several interest rate cuts. And all of a sudden, I think, you know, maybe now they're saying, well, 1 interest rate cut, right? Or 2 interest rate cuts or something like that. So anyways, long and short of it, interest rates and cap rates are not tied together. This is the proof why. Okay. All right. Okay. Next slide. So we're going to be talking now about the capital stack, right? And just the capital stack can look different than this, but roughly we're talking construction loan, 15% mezzanine financing, and then 10% equity put in by the developer. That money can be in terms of land also, a valuation land. So that's typically what we're dealing with. There's also a CMHC program called MLI Select, which doesn't follow this, but that's not what today is about. Okay, today is about the private developer who's gotten construction financing on it. Okay, so let's go to the next slide. So I think that we alluded to this several times last year that we thought that there would be more distressed deals in the marketplace. Is it too early? Right? Lenders have issues on their books. Or the other point that I think came up is, and David, I think I already mentioned it, when things reverse, they reverse quickly. Okay, so what we've been watching for the last year, maybe, like to use a classic term, a train wreck in slow motion, right? But don't assume that slow motion continues. Okay, David, I think that phrase came from you. When things reverse, they sometimes reverse quickly. Just expand on that a little bit.
Yeah, this is human nature. When a company has financial challenges, they're dealing with it just like they deal with a death in the family. And I use an analogy to the 4 stages of death: denial, anger, sorrow, and acceptance. If you're in any of the first 3 of those categories, if you're the owner of the complex, that anger, sorrow, acceptance, if you're in denial, anger, or sorrow, you're not dealing with your issue only till you get to acceptance. And often acceptance comes at the very last minute, and it usually comes at the end of a gun. And so you are far better off as a owner developer to get in front of the issues and address it quickly, to do what some people here have already talked about, which is, sacrifice an asset to save the better asset, to get some liquidity in the business. That process of denial, anger, sorrow, and acceptance inevitably leads to a crack or a break or a sudden break. Stress is built up. You can't take the stress anymore. And either the lender is causing the break or the investor is realizing it and panics and then goes to market fast, which also then probably brings in the attention of the lenders who follow them quickly thereafter. So if you're talking about that quick break, I actually think that that's human nature playing its part. That is very much, look, much of what we do in the restructuring business is actually around managing the personality of the person who's got the financial difficulty. And if they're one of those people that thrives in denial, anger, or sorrow, they're going to leave it too late. There's a tenant. I was the global chair of the Turnaround Management Association, global president and then global chair. And they talk about early stage restructuring of businesses. And that is getting in, it could only be 4 months earlier, getting into that scenario earlier, having a conversation with your advisor on how you can actually solve a liquidity problem that you're projecting out. Like if interest rates keep going this way and revenue keeps going this way, this is the hole that we're going to have, and we're going to hit a wall on this date. That 13-week cash flow analysis will tell you 13 weeks out that you've got a problem. You really want to know that 6 months out. And so you really want people to plan around that quick break. And if they're not planning, it's an opportunity for the buyer.
Right. So Darryl, David is talking about human nature, right? Talk to me about how you deal with a developer and get his story properly. Darryl McCullough.
Well, like with human nature, it takes us a while to get into the trust mode. And I like what David just mentioned, talking about the different areas that you go through. We go through denial and anger before we have to get to a decision. And one of the things about the journey, like I talked about earlier, about 2025, is that right now we're talking to people and who in an anger mode, or we really aren't in trouble. We're still building relationships there because the trend is not going favorably to them. So we just want to be able to be talking to them now, and so that they can make decisions that are beneficial to them, their families, and their corporations, if in fact the D-Day comes. And it's important to me to build relationships first, to build trust and go through it. Like I would say that David and Michel are working with us every single day with people that are coming in defensive mode, saying, I can solve this. But the more that they can feel comfortable, the more that Michel and David can give them advice that they really need to make decisions.
So you and our advisors, we're kind of like the guys talking to developers every day, right? What's the mechanics to doing this? You already started on it, but first we talked about is pull the mortgage. Why do you want to pull the mortgage?
Just explaining to pull the mortgage is that's probably the last thing you want to do, or you want to change the lending dynamics of the project.
No. When I say pull the mortgage, you just do a history on the mortgage, right? To see what is on the building.
Oh, well, I'm sorry. First thing you do, first thing you do is pull and know exactly what you're dealing with. I'm sorry, Derek. Yeah.
But
absolutely.
Why? For the people on the call, why do you pull the mortgage? Well, this is really good advice, everyone. Yeah.
Well, this is the most important thing about looking at the reality of the project. How much debt's on it? We talked earlier about where are you finding your equity? You're not going to find your equity till you know the position of that project in the marketplace. And you do consulting and workouts based on, if it's a 99% advanced mortgage on today's value, it's a lot different than a free and clear property and other problems that are there inherent that are not driven by mortgage, by debt. So yeah,
Okay, let me give-
pulling the mortgage is the first thing you do in any situation.
Okay, let me give you a real life scenario. You pull the mortgage on a property, right? And let's say the property's worth $9 million, $10 million. You pull the mortgages and you find out there's $11 million of debt on it. Fair enough? You meet the developer and he says, yeah, I'll sell if I get the right price. Okay? The guy's already underwater. You've pulled the mortgage. He's told you a fib, self-protection naturally. What do you do then?
Well, first of all, you're going back to what I said. You're really playing the asset business and not the relation business. The
Yeah.
asset business is telling you it's 11 million in debt.
Yeah.
But the relation business hasn't reached there yet. You have to dig in to let the other side know that you know that they're upside
Yes.
down.
Okay, and Michelle, David, you get it? Pull the debt first so the guy doesn't lie to you, if we want to be blunt. We got to have a real conversation with you, and this may be a hard conversation. It doesn't help with you pretending that you're in great shape and you'll take a crazy offer only. Fair enough? Yeah, yeah. You can't help someone who's not convinced of the truth.
The
Michelle?
important thing that we see in negotiations at this point is there's always a disconnect between the value from the developer and the value from an eventual investor. Is bridging that gap as quickly as possible to get everybody on the same page gets us closer and quicker to a solution. And it's hard to do that with some developers that have never seen a challenge in their life. What we're seeing today is there's a lot of younger developers that over the last 10 years made good money and now they're struggling and they don't know what to do. They've got no experience. They have to step up to the plate and recognize that their lack of experience is what's going to cause them more pain. And some of the older guys, like you were saying, all white older guys on this, but it's part of our job to explain to that generation that never lived through any challenges what they need to expect and why they need to come to grips with the reality sooner rather than later. And that's where the disconnect, I see it every day. Some of the older developers that feel the same pain, they're the guys that recognize it quickly. They try to pretend it's not there, hoping it's going to go away. Yeah. But at one point they trigger, they start selling core assets and recognize, I got to move on.
I love David's analogy about death. Those the pillars of getting to the reality. That is so true. So true. And we're all the same. None of us escape that because we go at it, and that's those stage things. It doesn't matter. It's very, very well done, what David said.
Yeah.
You know?
Okay, so we're just saying that like you need to have deep conversations with people. By pulling the mortgages, you know more, right? Talking to the trades, you're gonna know more, but you just more meetings and deeper conversations. And you know, these aren't Zoom discussions. Okay, these aren't Zoom. These are you're sitting there looking at the guy, you're looking at reactions, flinches, and so on, right? And it might have to be more than one meeting. It might be several meetings before you get to what the actual situation is. Okay, next page.
I have sorry for a second here. I have a slightly a different take on that. It depends on who you're talking to inside of the developers organization.
Yes.
You're talking to the CFO, they already know.
Yes.
They already know they're tight.
Yeah.
They drank the Kool-Aid of the young developer. Let's just use the example of the young developer because I've seen this issue over and over and again. It's not just in developers, it's in any business. Somebody who's come into a market, which is a bull market, they made some very smart plays there. In fact, very good financial buyers. They're pretty good operators. They don't run a super tight cost control ship. So they get into this situation, they get into trouble, and they think they can A, spend their way out, and B, that they can stall their way out. And the two things that happen there is they're getting a significant income from this. They bought that cottage up in the Muskokas, and they can't afford to have the cash flow of the business disappear on them. So if they haven't been socking it away and they've been burning it, then they've hired a CFO who is probably a little young for the job. This is just a typical scenario for us. Little young for the job, and that person is, you know, needs that job. They bought the smaller cottage next to the person who's the developer.
Yes.
They need that job, and so they want to believe that they have a solution. But the reality is, behind closed doors, that CFO knows. So
Yes.
if I were going to have a conversation, if the principal of the business, the president of the business, and the CFO were there, I'd have a financial advisor with me, and I would make sure that the financial advisor with me, because I often act for creditors, that the financial advisor with me actually has a sidebar conversation with the CFO and just walks through the numbers. And the numbers tell the story. And a person who's got an accounting background is just going to fall into it and go, oh shit, we're in trouble. And they're going to realize it. Now, the sooner they realize that, the lower the cost of the solution. The drag on the solution is very expensive. The solution debt gets more expensive, the cost of the professionals gets more expensive, and the pressure from the outside gets more expensive because you're getting into a defensive posture right away. If you start it early enough, the best person in financial difficulty is the one that grabs the bull by the horns early on in the process and comes to the table and tries to solve their own problem, and doesn't do it through a set of rose-colored glasses, and is realistic. Looks at their portfolio and says, we can sacrifice this to save these 10. And if that's happening, that's the right story. If that's not happening, then the likelihood is that you're going to get that quick break at a later point when the outside decides it no longer has faith in leadership.
Very, very good. Okay, next slide. So Michel, this is for you now, okay? So you got a problem. What do you tell your lender and when?
You got to talk to your lender right away. The thing that buys you the most time and the ability to seek out the right solution is your secured creditor is comfortable with you. Today, the most important thing is that creditor, that lender is comfortable with what you're trying to do and trusts you. If they get the impression that you've been sitting on this for 6 months and that the numbers are maybe not as rosy as what they should be, then there's no patience. Then they're going to be pulling the plug. So when do you go see the lender and explain to him that you have a little bit of a challenge and you need some support from him? Right freaking away. And be ready to listen to what the lender has to say. Don't start imposing solutions. Those solutions will be coming in at a later date. But the most important thing that will help you through the transaction today is if the lender trusts you.
Could you go to a lender too early and create a problem for yourself? I mean, the lender knows there's issues. Michel, and then David after that.
You know what? Yes and no. The lender, again, if your lending partner is a young new group that's only been lending in the last 5 years, they're going to panic and they don't know what to do. Make sure you're talking to the right people within that lending relationship.
Okay, good. David, that's a really good point. This is really good what you guys are saying, man. Like I thought I knew this stuff. David, go ahead.
So I would say I'm careful. I act for lenders. I also act for debtors, and I want to be ready to approach the lender. So I take a slightly different approach. The first one is I want to know the personality of the lender. I don't want to know the personality of the front end and the sales side of the lender. I want to know what the personality of the enforcement side of the lender is, because every lender has a different enforcement personality. Some lenders are scorched earth. Some lenders are patient lenders. Some lenders actually look at it as an equity opportunity for them. Some lenders are toehold investors. And so I want to know what they're trying to have an idea of what this lender has a reputation for in the marketplace when it gets in trouble. Inexperience Inexperience is a problem. So having that in hand, I go at a different rate to each lender at a different time, depending on what that personality is. The second thing is any debtor worth their salt, I call them debtors at this point, because now you're talking to a lender about owing the money. Any developer that's got a significant debt problem and a debt service problem, has a liquidity crisis on the go, they actually do need to have a solution. You don't want to blurt the solution out on the first day and the first meeting. You want to show that you're in the acceptance mode. We've got a problem. We're in the process of fixing it. We'll be back to you within 2 weeks with a solution. Now, when you build out that solution, if you're asking them for rope, only ask once and ask for enough, first of all. Second of all, if you're putting forward a plan, have a realistic plan. Don't have a plan that you're trying to sell to them. The realistic plan, asking for the right amount of rope or the right amount of forbearance from the lender, showing them that you are taking the steps to cut costs, taking the steps to take non-core assets and sell them, taking the steps to increase revenue, which, by the way, is that's the one everybody's the most skeptical about. Oh, I'm going to revenue my way out of this problem. That's the hockey stick projection. That's bullshit. It doesn't work. I haven't ever seen it work, and lenders don't believe it. You'll lose credibility on day one. You have to have a balanced solution, and you need to know how to talk the special loans lender language. And that is not the same as the language that you used for the people who put the debt on and were courting you to be your financier. In order to understand that, you better hire an accountant that has worked with lenders before, and you better hire a lawyer who knows what the hell they're doing with lenders really well. You don't want people that are confrontational. That's just building up for a war. You want to select a team early enough and put them together so that you're well versed on how to speak to the lenders so that you don't misstep. It is a very calculated conversation. You see the way I'm talking right now, thinking about my thoughts, making my point slowly. That's a very important element in any negotiation with any lender. And it goes through, you want to show that you're in that last stage already, that you're in acceptance and that you're leading your own solution, but you're looking for their coalescence.
Okay, next slide. We're going right into there. Yeah, really, really, really good advice. Really good advice. So, David, this is what we talked about before. Just any more you want to comment on? What's that? Oh, first, what does forbearance mean for people?
Okay.
Forbearance.
So if you've got a covenant breach, you've got a debt, a liquidity ratio that you're off in your covenant, or you've got some other covenant that you're off, and the lender is in an enforcement scenario, they have the right to call the default. Calling the default could lead to an increase in interest, potentially, the cost of the loan, or to fees. And so what you do is you enter into forbearance, and it says notwithstanding, it's not a waiver, it's forbearance. It's notwithstanding the event of default, the lender's not going to take any action as long as you do the following things. And they give you a list of things they do. That's a forbearance. So I just talked about this slide. Sorry, I got ahead of myself. I just talked about this slide previously. I think we've addressed it. That credibility is so incredibly important. I love the phrase, crow is best served to oneself warm. Everybody's heard the term eating crow, right? Eating your words because you made a mistake, or because you're in trouble and you have to admit it. If you delay eating crow, it's cold. So crow is best served to oneself warm. That is a testament to live by.
Just sort of deal with it. Okay. So Michel, you get your advice. David, your advice. Darryl, we're going to talk to now. You're the real estate broker, you're the advisor, right? And you're counseling, the joint venture partner, the developer, or the lender, or you're kind of this go-between guy before the manure hits the ventilator, right? What are the restructuring solutions here to get the guy through the fog. When you're restructuring a deal, start thinking now about the investor you're bringing in, okay? So the first thing we say is you put the joint venture partner you're bringing in a safety first position, meaning that if things go the wrong way, then their money, the developer's money goes first, and your joint venture partner money goes second, okay? The other example of a safety first would be where the investor coming in to save the deal gets a preferred return. Maybe the preferred return is 8% on his money as you go through the workout. When the jackpot date is hit and a sale or a refinancing occurs, then again, you get paid out your pref return first. And after that, then there's a splitting, right? And your joint venture partner, unless they're very sophisticated, you typically don't want them on covenant, okay? And so that's what we mean by overall by a safety first clause, right? Sometimes you can subordinate the debt. Michel, maybe you can talk about that. You can cross collateralize. Sometimes, and nobody thinks about this, you can exchange real estate, okay? So you've got a guy that's sitting there with an apartment building that's half finished and he needs money. Fair enough? And you got another guy sitting there with a free and clear piece of land. Fair enough? He may be able to trade or monetize that with the developer because the developer says, yeah, when I get to this, what are you going to do with the money? I always say to a developer, I'm going to buy more land. Great. Maybe we can use another asset that somebody owns and swap it. But again, you never get to a swap or a trade exchange, excuse me, unless you ask this question: what are you going to do with the proceeds of the sale? And as soon as guys, well, oh, I'm going to go do this again. But wait a minute, I've got a guy who'll do that again with you, and he'd love to be your partner here, and he'll keep the fully finished building, and you can have his land. Fair enough? Or anyways, there's a bunch of exchanges like this that you can do, but you've got to be creative, and this is the time to be creative. Michel, any comment on the subordinated debt cross collateralization?
Actually, yes. On the subordinated debt side, what we've seen in the past with development projects, cost overruns being a significant pain point over the last few years, you're going to need more mezz. We saw the capital stack before. You had 10% equity, you had 15% mezz debt, and you had 75% your standard debt. The cost overruns come in. Where is it going to go? Your mezz portion is likely to be increased, reducing from 75 perhaps to 65 the participation of the secured debt, and the new money gets subordinated to the existing money there. It's the only way to get that done. Cross-collateralizing is also an excellent option, which causes even less pain. But it means you're putting up equity that's sitting in an outside project to support your needs on a current project. To me, that's the quickest and the least, and the way that produces the less pain. Cross-collateralize it. It's not going to cost you that much in interest. It's not going to cost you more in preferred rates to mezzanine lenders. But subordinated debt and cross-collateralizing have to be top of mind when you're looking at finding a solution to cover your current pain points in current construction projects.
Okay.
So,
David?
So my only caveat about cross-collateralization is you better not be suffering from something called the sunk cost fallacy, which is if the property is underwater and it's never recovering, sometimes handing the keys. If you've used an SPP as a single purpose vehicle and you're big enough and you don't have any direct corporate debt other than on the project itself, and it's isolated, it's bankruptcy remote from the rest of your business, sometimes you're better off to pass the keys. The moment you cross collateralize, you break the ring fence and expose yourself to an asset that might have a bigger hole in it than you expect. You need to understand whether you're suffering from sunk cost fallacy. And for people who don't know what sunk cost fallacy it is, oh, if I just spend another $100,000, everything will be better. But that $100,000 is lost and you're never getting it back. And so you're operating under a sunk cost fallacy, meaning I've got 5 million in, 100,000 more is not going to hurt me, or 1 million more is not going to hurt me. It's going to make the project come out. And the reality is that money is just lost. And so you should have walked away earlier. Sometimes fish, sometimes you cut bait. And knowing that before you cross collateralize, I can tell you that I've had clients who are emotionally wed to the asset.
Yes.
And they've made bad economic choices backing the asset, and they've pulled the entire enterprise down as a consequence. That's not just in real estate. That's across the business strategies. Personal guarantees, cross collateralization make me a little bit creeped out.
There's words of wisdom from David there. I love what you're saying. And to me, that underscores the point of when you're having a little bit of a challenge, please reach out to people who have been through this before.
Yes.
So that they're presenting every possible avenue of solution and pointing out the pros and the cons of each of those solutions. Sometimes, like you said, you're trying so hard to find the right solution, you're not paying attention to this might be a complete waste of time. Yeah, just hand back the keys and focus on other projects. So well said.
So Michel, hold on. So we're talking about apartment. Typically, our apartment construction loans unsecured or secured with the personal covenant of the developer?
With the personal covenant of the developer, just about every lender, and 99% of the lenders during construction require a personal or a very significant corporate guarantee.
So you've broken the fence anyways.
Yeah, but not specifically. Like cross-collateralizing gives the secured lender direct, access to that. A personal guarantee doesn't provide direct access to anything.
Yeah. You can fight
unsecured it. You're fairly far down the waterfall. If every other project inside that family has collateral, you're fairly far down the waterfall. And corporate guarantees are okay. Personal guarantees will always cause you problems.
Right. Okay.
A personal guarantee for people on this call, a personal guarantee is what I call an attention getter. Do I have your attention? Hold on.
Yes.
Let me grab you hard by the personal guarantee. Now I have your attention.
And I think that people fail to recognize that a personal guarantee is meant to be just that. When the manure hits the ventilator, to use your term, Derek, the bank wants to know it's not going to be left alone. The person in the best situation to resolve the and to limit the pain for the lender is the guy running the show, assuming that, he wants to find a solution. So to me, that's exactly what it is. The moral guarantee, the attention getter to say, hey, step up to the plate and let's find a solution before we come after you. And sometimes you use that to negotiate away your personal guarantee. Sit with the bank, collaborate, show that you're maximizing the liquidation value if you end up going down that route in exchange for your personal guarantee being released or limited.
Okay, good. Okay, next slide, sir. Okay, so I've got a few sort of general questions before you. Before us, go back to question and answer slide, or just go full screen. So, and if there are any questions from the audience, now would be a good time to put them in the Q&A or in the chat. And Rod, maybe if there are any, you can marshal them. Okay. So how are the people who provide expensive debt doing right now? Like we've been mainly referring to the construction financing from Schedule A or larger lenders. How are the B lenders doing, the hard money lenders, the guys that were charging, first it was 8%, now it's 10, 12, 15%. How are those guys doing in the marketplace today? David and Michel?
Michel first.
Okay, well, I think those lenders are doing much better. And when you're talking in today's rates, hey, all of a sudden 12, 13, 15% doesn't seem so bad. When prime plus 2 is 9.25 or 9.20, 12% and 15% isn't that far off the mark. I think good secondary lenders, good mezz lenders today have the opportunity to support good borrowers that they didn't have access to, where good developers said, no, I don't need that mezz money. That's a little too expensive, 12%, 15%. I don't want to deal with Shylocks. Well, Shylocks is not 12, 15%, by the way, but developers, and they're extremely conscious, the builders. So saying that I'm paying 12% or 15% or even 18%, it just rubs them the wrong way. But today, it's part of the solution. Today, it's part of the process, getting you over the hump and through the process so you finish the building. So they're busy. And what we're seeing is the good mezz lenders are busier than they've ever been today.
Okay, but there was some mezz lenders who lent money 3, 4, 5 years ago, up the capital stack. That's the guy I'm referring to. Do you see any pain there?
Some mezz lenders are in extreme pain because they weren't able to get many of their loans repaid, and have, I don't want to say gone out of business, but put the whole program on hold because they're not getting the returns that they expected on the money that they invested. And when I'm talking about the mezz lenders that are doing well, it's more like the institutional mezz lenders, the guys that don't have a problem putting out 40 million at a time.
Okay, so let's just let's look back and see who got in trouble and who didn't. Okay, so far, and who could get in trouble. Okay, so I'll give you my take on this, right? So number one, if you're looking to place money with someone, you're looking at the developer's track record and character. Fair enough? That's sometimes 80% of the decision. Okay, so if a developer has built a project 5 times already or 10 times already, and he's producing cookies, he's stamping them out. I build a, you know what I mean, a 4-story wood building, 60 units, and I build 20 of them. Fair enough? Or I build 40 of them. That guy typically doesn't get in trouble. Fair enough? Because he knows exactly what he's doing. And you know what? Yeah, he could make less profit because things get tougher, but he's got enough of a profit margin in a window there, right? So that's number one. Track record, history, and then I would say character and values of the developer. Probably the most important thing you've got, right? The second thing is, you know, where are they building in the market? You're building A++, okay, and your rents have to be $5,000 a month and down. Yeah, you'll get 5,000 at the top of the market, and there and so on. But that's a pretty thin part of the market. The area is pretty thin at $5, $6 per foot. You got to be in exactly the right location, with exactly the right team, et cetera, right? But that guy, I think, can get in trouble, right? And so on. And then the guy who just doesn't have good financing on it, right? So what we're looking for on deals is between the developer and the investor is to have a good slug of equity in there, right? And when you don't have enough equity in there, you've got that 80, 90, 95% financing, right? And that's where you can get in trouble because you can't weather any storm. So I would say overall for deals, keep it simple. So if a developer says, I've built 4-story wood all my life, I can do it in my sleep. And then he comes to you with a podium product made of core slab that he's never built before. Well, that's not the deal I want to invest in. Fair enough? So invest in developers that are tried and true. They've done it over and over again. They value engineered it in, and it doesn't need to be exciting product. It doesn't need to be stuff that's over the top of the waterfall and things like that, right? And then what I would say is I also want to be as close to the middle of the market as I can, right? Because where you get in trouble is rents. And when you build, let's say, to the 75% of the market, as opposed to the top 100% of the market, I don't be the highest rent. And somewhere between 50 and 75% of the rent in the market, that's a safe spot. Fair enough? And then you want to build in markets that aren't complicated, that aren't so a simple product in a straightforward market where there's not a lot of overbuilding. So recession isn't the problem in apartments because people always need a place to live. It's oversupply. We don't see that a lot in Canada. The only market that ever got oversupplied that I know was Fort McMurray. construction there, and then all the, when the oil problems occurred and so on. So that's what I would say is the safe bet. Good developer, right? Building a product that he knows. There's a good chunk of equity in there from the developer and his investor that you can weather a storm with a predictable result, with a kind of a mid-market rent, right? Top of the market rents are fine when the market's fine, but when the market's not fine, then top of the market rents become unattainable, and they tumble down pretty quickly or rent level. Fair enough. That's my sort of safety clause formula that I use when making decisions on should somebody invest in a deal or not. But 80% is the developer. I don't care how good the deal is. If you don't get a good feeling from the developer, then you should not be refinancing that deal or putting equity money into or something like that. Right.
Hey, Derek, I just
David,
want to let you know that Darryl's back on with us, number one, and we
Okay.
do have a couple of questions when you're ready. One's in the Q&A box and one's in the chat box.
All right. Okay. I'll have a quick look at those. David, what are your thoughts on just,
So, I love your, can you guys see this? No, you can't, can you?
yeah,
That's
pretty low, but we
okay,
can see it.
that's a bell curve. You just described a simple bell curve analysis, which is you want to be in the middle quartiles, between 45 and 70%. You want to be in the thick part of the market because that's a part of the market that will have more support. There'll be more transactions in it. It makes perfect sense. It's a really good analysis if you ask me. Look, I can't talk about who's losing money today, because we haven't seen enough of the breakage to know if the mezz lenders are actually in trouble or not, the ones that put the money out in 2021, 2022, 2023. But the mezz lenders that are in the market today can cherry pick. They're going to have their choice of the best deals. They're going to have their choice of the best developer. They're going to have their choice of a patient lender stack, because the one thing you didn't add to that was the personality of the existing lender stack. What you don't want to be is the mezz lender into a volatile lender stack. You want to know that the senior wants you there. You want to know that the senior is patient money and that your money is actually buying patience, right? So if you're coming in as a mezz lender to a troubled situation, you're calming the water.
Yeah.
Right. And if you're not calming the water, then all you're really doing is a toehold because you're a buyer.
Yeah. That's a really good point. One other point I want to make about making a decision to put money in a deal, whether it's a ground up deal or whether it's a deal that just needs to be recapitalized. And nobody, I don't think we think about this enough. Think about the governance of the jurisdiction that you're investing in. Okay. So pop quiz, 2 identical deals, one in Alberta, one in Ontario. They're identical. They're twins. Which one do you invest in? Darryl?
Alberta.
Yeah. David? That's all I have to say. David?
Honestly, you mean today? Or
today?
Today?
No,
Alberta.
today generally.
Alberta today. Alberta today.
Michel?
Alberta's already
Michel?
had their shutter.
So
Michel?
I'm saying Ontario because my ability to realize on my security is quicker and more efficient.
Yeah. Yeah. Okay.
But Alberta's a better place to invest because the market is healthier and better there. So it all depends where your mindset is at.
Right. In a world that's bifurcating politically, fair enough, and it really is bifurcating hearts of our poor. I think Alberta, and we've done lots of seminars on this topic, we call Alberta Canada's only red state. Maybe Saskatchewan is too, but it's so small you can't get any traction there, right? So we are fans of red states with good governance that we have very, very little land oversight, just common eviction rules, right? Because we think that those are also major headwinds facing us. If you take Ontario, look, this is where we live. We love Ontario. But if Doug Ford loses the next election and whoever the Liberal leader is, Bonnie Crombie, with a small or a minority government, there's a lot of pressure on rent control legislation right now, right? Ford wins hands down. He's probably good. wins hands down. Who wants to open up that nightmare? She's kind of pro-business. She's from Mississauga and so on, right? But I got to tell you, don't face that problem in Alberta. Fair enough. It's a dyed-in-the-wool red state, and you don't face that problems in red states in the US, right? So governance and apartments right now, and rental is a political football. Nobody cares about industrial. Nobody cares about hotel rates, but rental rates are kind of sacred. So I'd be careful about where you invest, given the world that we live in now, where we've had so much government overreach. We can't look. We could spend all day talking about this, but just one round of comments back again. Michelle, you want to change your vote and get it right, or you're going to stick with Ontario?
I'm sticking with Ontario if I'm concerned with my ability to realize, and Alberta is just a better market right now. I'm less likely to realize in Alberta.
My choice of Alberta is based on they've already gone through a recession. They've already had their consumer and housing reset. They've already had their price adjustments. It's already imputed into their marketplace. They've gone through it in the last 5 years. And as a consequence, they are weather tested and slightly more resilient than Ontario. Ontario is still a bit of a dream state on the real estate market.
Okay, Darryl, any more comments just on, we talk a lot about governance and the importance of governance to where you invest your money.
So, being the oldest one on this panel, I remember 1975 like yesterday. Our whole lives changed in 1975, and that's when I started going to all the Albertas in the United States. Not because I don't love where I live and everything else, but I'm not a fan of socialism.
Okay, good. Yeah. I think that's what it comes down to, right? What is your view of the world? Do you view more government is better for you? I know what you all believe. You're all entrepreneurs on this call, right? But you start thinking about your staff and your kids. Ask your kids what they believe, right? Yeah. Anyways, okay. So good answers. Let's go around and questions. Maybe you could read them off if they're answerable. I don't know. Go ahead, Rod.
Well, the first question was, how can we avoid having to put forward a personal guarantee? Because typically no personal guarantee equals no loan. Go ahead, David.
It's going to be a trite answer.
Just say no and keep looking for financing. Just say no. Find a creative solution to it. Find an asset that you can do a limited recourse guarantee. Do a guarantee that's supported by a pledge of a specific asset, and don't allow that to expand over time. And
put more money down. If you want to make the lender feel comfortable, put more money down, and then do a limited. Yeah, good answer. Okay. Any other, Michel?
No, there's not much that you can. There's not much you can do when it's the golden rule, eh? The lenders have the money; they'll dictate what they want. And if you're looking for easy access, it's something that you just have to get used to providing. I like the idea of limiting it. What we're seeing is lenders are becoming more accustomed to limiting that recourse, or providing specific asset to limit the recourse. Or here, I'm going to give you full recourse during construction, and then we're going to ratchet it down to 40%, 30% once it's stabilized.
I like that. I like the ratcheting down. I would also tell you that trust structures make it hard to get personal guarantees. If your assets are held inside of a trust structure, so that the beneficial interests of the asset are held among an entire family as opposed to one individual person, when they come to you for a guarantee, they just look at them and say, sorry, this structure doesn't support guarantees because beneficiaries of a trust don't give guarantees for the trust. And so if you want to do business with us, I'm sorry, you're not going to get a guarantee.
Okay. Darryl, what about this idea? So the guy doesn't want to put his personal covenant on a mortgage. Right. Building. What about if personal covenant on it and a piece of the deal? So you're a great builder, but you don't have the bench strength to put the personal covenant. You don't want somebody else put the personal covenant on who's rich, right? And so on, and they can step in. Darryl, what do you think about that idea? We've talked about that before.
Well, we do. You can trade off and buy a covenant if we like, for a piece of the
Yeah.
ownership. There's people out there that are prepared to do that all the time. You can also turn your development into a potential joint venture so that you understand how important it is not to have a covenant. And you're saying, I'm prepared to give up ownership, getting more equity in so that I get non-recourse financing. So there's a couple of ways right there. There's also, I think we talked about earlier, cross collateralization. You may bring in another asset to negotiate non-recourse with an exit through a partial discharge or something like that.
Right. So we're talking about
Or,
restructuring.
yeah, or
Yeah.
just add more assets to the investment. So it could be just, I'm gonna put some more assets into this besides this development site. I got existing real estate that I will put in, but I'm not signing a personal guarantee.
Right. So we're talking about restructuring new apartment construction here, right?
Yeah,
So we're talking about bringing money to a deal that's already started or a deal that's going to start. So we always want to have the safety first clause for our investor, right? So that their name is never going on the covenant, the equity partner, right? And the developer always has a guaranteed minimum price. They're going to complete the project at this price. If they don't, any cost overrun is theirs and they're going to eat it, right? So you got to be looking at those safety clauses. Okay, all right, really good discussion, and I hope all of you who are with us here are recognizing the value and the wisdom of this panel. I'm not sure we would get this if we had equity in whatever it's called. Do you know what I mean? Yeah. This comes from people who've been doing this for diversity and equity. This comes from people who've been doing this for a long time. Okay. All right. Next question. What do you see happening in 2025? We're going to come back a year from now, maybe do this again. What's your guess as to what happens? Michel, you go first.
I think in 2025, we're going to see just more of the same in terms of new apartment building. There's nothing that's happened in the economy that allows a lot of the projects that are just on the sidelines to move the needle for them to get in the middle of traffic. So I think 2025 is going to look a lot like what we're seeing exactly today.
Got it. Okay, David, what do you guess looking for the next 12 months? We were sort of all wrong last year. We thought there'd be more pain, or maybe the pain is behind the curtain, is what you're saying, right? Yeah. David, what do you think?
I believe that the consumer is in more pain than our government wants to admit because both countries are in election mode. And so I think the consumer is hurting. And, James Carville, who was Bill Clinton's political advisor during his first campaign, James Carville said to the Democratic Party, "It's the economy, stupid." So they're all focusing on all sorts of other things. But the reality is you have to talk the economy from a political standpoint. And what they're doing, in fact, is, the conservatives are talking the economy because they know that that's the Achilles heel of the current government. The government is talking everything but the economy, and they're making it look like, the individual is in a better situation. I think that my biggest concern is the interest rate differential between the US, Canada, causing us to have a dollar crisis that will give rise to continued inflation in this country that will hold our interest rates higher so that we can attract capital to this country. And I'm worried about that. That worries me every single day. And so in my own investments, I'm hedged into the US for that very reason, because I don't think the Canadian economy in the next 3 years is going to perform. And I think we're going to have a real problem.
Sadly, so when you are hedging into the US for diversity, for safety, and maybe currency exchange, you could win in that area too?
Yep, that is exactly what I've done personally.
And I got to tell you, that's exactly what I'm doing as well. Okay, is investing in, it's amazing you say this, David, investing in red states, okay, mid-market apartment developers, not the A++ stuff, right? the solid middle of the market in growing good governance places, I think is super safe. Darryl, what do you see happening in 2025?
So our target market too is US focused as far as underwriting goes. As far as Canada goes, as I said earlier, it's continuing to build relationships with developers who are now in the development phase in different areas, so that we can, where I believe we'll be starting to see some unraveling in 2025. And it's not, you don't wait till then, you start talking now to see, first of all, how you can add value to their life and help them. And that's what I'm doing in Canada.
Yep. Okay, Rob, is there one more question we can ask?
There was just one about a tool. Any recommendation on which tool or application can be used to identify, companies or individuals currently facing mortgage challenge, such as being underwater, having a subordinate mortgage, or experiencing delays or forbearance on payments?
Yeah, it's a good question. I mean, there's a bankruptcy statement that comes out every Monday, right? But that's the stuff that goes into the receiver's hands. This stuff that Michel and David was referring to is where you find the deal before it hits the newspaper, right? Look, this is. I don't think there's a mechanism here other than relationships. You've got to stay in traffic. There is no pre-warning, okay? Or there's no analyst like there's in the stock market saying short this, go long on this, whatever. This happens, but the takeaway from here is figure out the people who are in the know, okay, on this. And then the other advice that came to you is you got to move quick, because the bank or the receiver isn't that far behind, right? And the developer is putting up a brave front, right? So it's a really good question. The answer is, I don't think there's a shortcut. Anybody got a valid comment on this? Otherwise, we'll move on to the last question. I don't think there's a shortcut.
I agree with you on that.
Yeah.
In the US, for large corporate debt, there are large corporate debt tracking systems. In Canada, we don't even have that. There are only a few of the Canadian companies that are tracked in the US indexes for corporate debt, and when the renewals are up, and the aging of the debt, for example.
Yep.
And watch lists. But the big accounting firms the four big accounting firms have real insight, because most of their clients are in that mid-market space. Knowing those accounting firms well is probably helpful. They've got confidentiality issues around that. But what you want to know is that you're a potential. They have to know that you're a potential investor and that they've come to you at the right moment. You have to be, look, there's only a handful of people in the country who play in the distressed space. If you don't know them, you're not on the inside.
Yeah. It's hard. Okay. Last question. You get to give the audience a final piece of advice. Okay. Remember, the title of this seminar is Restructuring New Apartment Construction, right? So, an opportunities to restructure new apartment construction. What's the piece of advice you'll give them? I'm going to go first because it's my webinar. Okay. It depends on the developer's character. Fair enough. And I would just say that before we write a check, me and our clients, and to anyone, I make a point of just spending time with the developer. Fair enough. With their staff, on their building, talking to their frontline staff, eating dinner with them, doing shots with them. And I tried to get them to invite me to their house. Okay. And you might wonder why I would do that, right? Because I want to understand the person. Fair enough. I want to understand the character. I want to meet their wife. I want to meet their children. It's not always possible to do that, right? I want to talk about the two partners, because oftentimes in the deals we've done, there's always been two principals. What's your relationship? How did you meet? How do you solve problems? What happens if one of you has a problem in your life later on? What does your partnership agreement look like, right? So very much spend time with the developer. I wish there was a checklist where I could go through character of the developer. Tick this off, tick this off, tick this off. You know what I mean? Yeah, there isn't, and then checking their references, and not necessarily the references that they give you, tangential references in the area, right? And, when you get a good guy, people, and I ask their competitors about them. Fair enough. And I'll call and say, look, we're thinking of writing a check to this guy, and says, what are they like? And the competitor says, yeah, they're good guys, right? I mean, you can't get a better testimonial, I think, from someone's competitor. And spending time with them is the point I'm making. Okay. Darryl, what's your single piece of advice to people who are restructuring new apartment construction deals? Michel, you get the last word.
Well, basically, I would say that people that are in the business are going to have bumpy roads on their journey all the way through the many years. Don't be looking at somebody that they've got a bit of a problem now as somebody that's not worth your time, because they are worth your time to find out if you want to put some more time in them. You need to go and stay in traffic. You need to meet them. You need to understand their whole history. And that means you can figure a real estate deal out probably in half an hour. It may take you 3 hours or 3 years to figure out that relationship. And that's the most important part.
Yep. It's not, I mean, it's real estate, but it's not on an Excel spreadsheet. Okay. David Cohen, what's your parting advice to people?
So this advice is to the
in this area.
This advice to the developer. Okay, not to the buyer, active investor, but to the developer. Act early and hire a translator. And when I say a translator, I mean hire somebody who, not the person who does your audit, because I mean, no offense, they're useless when it comes to turnarounds. Hire somebody who speaks the language of turnaround, because what you want is to find an early, creative, low-cost solution to your problem. And if that's divestiture, then getting to that earlier will often fend off a problem later. The biggest mistake is dragging your heels.
Yeah. Okay, Michel, last word to you.
I agree with David. Procrastination is the biggest issue that we're dealing with right now. When we're trying to help people align their strategies, Derek, I'm going to get back to this. I think it's important that you're matching the investor with the borrower, and that there's an alignment of strategies. I liked your analogy saying, I like to go see them. If I were doing that, I'd like to go to their house and I'd like to see, is it that huge glamorous house that has 2 Ferraris in it? Or is it a nice house with a 150 Ford pickup and, you know, a 2-year-old Toyota Caravan that the wife takes the kids to soccer in? There's a big difference. And 100%. I align quicker with the 150 than the Ferrari. And I think you have to take the time, and Darryl said that, take the time to understand what's really going on. David saying experience is important. Hire the experience that you don't have, and don't be afraid to listen to it. So align the strategies and make sure you're dealing with like-minded people, and listen instead of always just saying your piece. You have to listen.
So really good points Michel made. Number one, that the choice car for a developer is an F-150. I'm guessing 40% developers drive an F-150. I don't know why it's that, but they do. Okay, so really good point. Really good point, Michel. The second one is, your culture and their culture need to jive. Okay. And I'm going to, Rod, I don't know if you can bring the slide up. Don't worry, I redraw the map of North America. If you can, you're a genius to do it like this. Okay. But what I think about is, and you'll see it in a minute, you need to get a culture. And again, this is not an Excel spreadsheet. You got to feel good before you write somebody a check or extend their loan or something like that, right? To knowing that the person is prudent, knowing they're comfortable with the hammer in their hand. You know, if the guy shows up, you're right, in Gucci shoes with no socks and a Ferrari, and he wants money, you're not feeling good about that, right? So a lot of decisions come down to emotion. And then I think, why is my emotion towards this person very positive, yet my emotion to this person is less positive in a similar deal? Because of the alignment of values and cultures, right? And look, we are not geographically bound, but since we got a couple of minutes, here's my thesis. We've got 50 states and 10 provinces, right? If we eliminated all those states and provinces, limit all those lines, and we redrew the border, I'm going to argue that we would wind up with 6 countries. Okay? I think that Alaska, the Yukon, the Northwest Territories, those people are very similar. They're nothing like people from Florida. Fair enough? There's country number 1. The people in BC think, act, and they come to seminars in shorts when I go to Vancouver. In Toronto, everywhere come to seminar in shorts, right? So their culture, their mindset is the same as California, Oregon, and British Columbia. It's a north-south. Culture doesn't go east-west, it flows north-south. This is good stuff, isn't it? Right? Okay. Now, the heartland, when you go to Alberta, Albertans are like Texans and Oklahomans and things like that, right? There's that farmland. They all drive F-150s. Fair enough, right? And so on. And then you look at where we are, central Canada. I don't know about you, but I feel the most comfortable in the US city in Chicago. Okay? Great Lake City, transit, big. I don't feel that comfortable in New York. New York is its own animal, right? New York and Florida, there's a lot of influence there. So I think this central Canada piece, okay? And if you had a country, it would go north-south. So when you look at the states that come in here, it's the Midwest in the US. It's the industrial heartland. It's people who are culturally similar. And I would argue we have more similarity with the people in Ohio, Indiana, Kentucky, and so on, than we do with the people in the Yukon or with the people in British Columbia. Do you see my point? Right? And I'm saying the East Coast is kind of the East Coast. New York has this dominant effect, right? And then the Maritimes, I'm thinking the people in Maine have sort of the same interests and so on as the people in Nova Scotia. So my thought is when you think about where Canadians vacation, they vacation north-south. Albertans don't go to Florida. They go to Phoenix, right? They go to the desert. They go to Palm Springs and so on. Central Canadians don't go to Palm Springs. You don't like the time zone change. There aren't enough flights. You sort of go north-south, right? And so on. So investing, I feel, is the same way. You invest culturally with people who fit with you, and that north-south graph sort of illustrates my point. Any comments on that theory?
You have to take Florida out of it. I have no idea where Florida goes anymore.
I know, I agreed. Look, I think Florida is actually a great place to invest, but it's the problem with the red states. Rod, can you bring up? No, this is fine. It's fine. Some of these red states are great to do business in, and everybody piles in. And as I said earlier, overbuilding is the problem, right? It is the real problem to apartments. So go to places that are not overbuilt, that are growing, that don't hit the radar screen of Blackstone and things like that. Anyways, thanks for that slide, Rod. Okay. So I think that is it. Thank you, everyone, for coming here. Maybe in a year we'll do it again, right? And see that.